Before we begin, a quick note. This video is for education and awareness. It's not financial advice. It's about understanding how money really works, so you can make clearer decisions inside the system. Now, let me ask you something. Have you ever noticed this? You earn more than you did 5 years ago. You work harder. You're more experienced. And yet, you don't feel richer. In fact, sometimes you feel more anxious, more careful, more stretched. You save. You budget. You try to be responsible. Still, the pressure doesn't go away. Groceries feel heavier. Rent feels heavier. Insurance feels heavier. Life feels heavier. So the quiet question starts forming. How am I doing everything right and still falling behind? Here's the uncomfortable truth. You and I are playing a financial game that most of us were never taught the rules of. We were taught how to earn, how to spend, how to borrow, but almost never how money itself is designed, how it's created, who benefits from it, what incentives shape it. When reviewing how modern monetary systems operate, one pattern stands out. The system rewards participation more than understanding. Here's a personal thought. The moment I truly started feeling calmer about money wasn't when I earned more. It was when I understood the rules, when I stopped blaming myself for structural problems. Today, we're going to make those rules visible. Not to scare you, not to make you cynical, but to give you something rare in finance. Clarity.
For most of human history, money was tied to something physical: gold, silver, land, grain. If you held money, it represented something that already existed, a real resource, a real limit. It wasn't perfect, but it created one important boundary. You couldn't create unlimited money. Then, in the early 1970s, that boundary disappeared. In 1971, the United States officially ended the system that linked the dollar to gold. From that point forward, the dollar was no longer backed by a physical asset. It was backed by something else: trust. Trust in the government, trust in institutions, trust that this paper or this digital number would still be accepted tomorrow. This is what we call fiat money. Money that works because society agrees it works, not because it's tied to something tangible. Now, this change wasn't evil. It wasn't a secret plot. It happened because governments wanted more flexibility, to fight recessions, to fund emergencies, to stabilize markets. And in many ways, it helped. But it also changed something fundamental. Money stopped being scarce by nature. It became adjustable by policy. When reviewing how central banks manage modern currencies, one reality stands out. The supply of money is now a decision, not a discovery. It can be increased, slowed, redirected, with meetings, with votes, with formulas. Here's the strange part. Most of us still think about money as if it's solid, as if it's fixed, as if it represents permanent value. But in reality, it represents confidence. Confidence in systems, in stability, in tomorrow looking like today. And when confidence weakens, money doesn't disappear dramatically. It quietly loses power, less buying ability, more pressure, more chasing. This is the foundation of everything we'll discuss next, because once money becomes flexible, so is debt, and that's where the real architecture begins.
Most people imagine banks as simple intermediaries. You deposit money. The bank keeps it safe. Then it lends that same money to someone else. It feels logical. It feels responsible. But that's not how modern banking actually works. When you walk into a bank and take a loan, The bank usually does not take existing money from someone else's savings and hand it to you. Instead, it creates new money, digitally, out of the act of lending itself. Here's the simplest way to see it. Imagine a bank receives $1,000 in deposits. Traditionally, you might think that means it can only lend $1,000. But under fractional reserve banking, the bank is required to keep only a portion of that as reserves, let's say 10%. So it keeps $100 and lends out $900. Now that $900 gets deposited somewhere else. That bank keeps $90, lends $810, and so on. Through this chain, the original $1,000 turns into several $1,000s inside the system, not printed, not mined, created through bookkeeping. When reviewing Federal Reserve explanations of money creation, one point becomes very clear. Most money today is born as debt. It enters the economy when someone signs a loan, a mortgage, a student loan, a business loan, a credit line. No loan, no new money. Here's a personal observation. The first time I truly understood this, I stopped thinking of banks as vaults. I started seeing them as factories. Factories that manufacture money through contracts. And those contracts always come with interest, which means every dollar created arrives with an obligation attached. You don't just borrow money, you borrow pressure. Monthly, predictable, relentless. This system makes credit powerful. It helps people buy homes, build companies, start lives. But it also means the foundation of our economy is built on promises to pay in the future, and that creates a quiet dependency, one we're about to explore.
Now let's connect the dots. If most money is created through loans, and every loan comes with interest, then there's a quiet mathematical problem hiding underneath the system. When a bank creates $100,000 through a mortgage, it doesn't create the extra $40,000 that will be paid as interest over time. Only the principal is created, not the full amount owed. Which means, system-wide, more money is always owed than actually exists. So how does that gap be filled? With more loans, more credit, more borrowing, more expansion. New money has to be created in the future to pay for money created in the past. This is why modern economies are built around growth, not as a lifestyle choice, as a structural requirement. When reviewing long-term debt and monetary data, one pattern repeats. When borrowing slows down, stress rises everywhere. Jobs weaken, markets fall, governments intervene, rates change, because slowing the engine threatens the whole system. Now, here's where this becomes personal. This growth pressure doesn't stay in boardrooms. It shows up in your life, in rising housing prices, in career competition, in hustle culture, in the feeling that standing still is dangerous. You're not just encouraged to earn more, you're pushed to, because stability in this system often means acceleration. Here's a reflective observation. Many people think financial stress means they're failing, but often they're just trying to survive inside a machine that needs constant motion. If you pause too long, if your income stalls, if one setback hits, the system doesn't slow down with you. It keeps moving, and you're expected to keep up. This doesn't mean growth is bad. It means growth is necessary here, and anything necessary eventually creates pressure. That pressure shapes every financial decision we make, even when we don't realize it.
By this point, you might be thinking, if the system is this complex, surely someone is making sure people don't take on more than they can handle. That feels reasonable. It feels responsible. And in theory, that's what underwriting is supposed to do. When you apply for a major loan, banks look at things like your income, your credit score, your existing debt, your payment history. One of the main numbers they use is called a debt-to-income ratio, DTI.
It measures how much of your monthly income is already committed to debt. If your DTI is below a certain threshold, you're considered safe, so you're approved. But here's the uncomfortable gap. Approval is not the same as protection. Underwriting is designed to answer one main question: can this person probably make the payments most of the time? Not, will this person still be okay if life gets messy? Because life always gets messy. Medical bills, job changes, childcare costs, family emergencies, inflation spikes. These things are not rare, they're normal. When reviewing modern lending standards, one incentive becomes clear. Banks are rewarded for volume and performance, not for long-term borrower comfort. If you pay on time, the loan is good, even if you're exhausted, even if you're one emergency away from trouble, even if saving becomes impossible. Here's a personal style insight. Many people think, if I got approved, it means I'm being responsible. In reality, it often just means you fit the model. The model doesn't see your stress. It doesn't see your mental load. It doesn't see your future risks. It sees probabilities. And probabilities don't protect individuals. They protect systems. That's why so many financially qualified people still feel financially fragile. They weren't reckless. They were optimized. And optimization is not the same as safety.
Let me share a story with you. This is not about one specific person. It's a composite example, built from patterns seen across thousands of real households. Think of it as a realistic snapshot. Meet Daniel and Rachel, both in their early 30s, 2 stable jobs, 1 young child. Together, they earn about $95,000 a year. On paper, they're doing well. After taxes, their monthly take-home is around $5,800. When they apply for a mortgage, they're approved for a $380,000 home. Their payment, including taxes and insurance, comes to about $2,300 a month. That's just under 40% of their net income, within standard guidelines. So, they buy. At first, things feel fine. Then life happens. Daycare rises by $300. Groceries rise by $250. Car insurance jumps. Utilities creep up. Nothing dramatic, just gradual. Now their fixed costs look like this. Housing, $2,300. Daycare, $1,100. Car plus insurance, $650. Utilities plus phones, $350. Groceries, $800. Minimum debt payments, $400. Total, $5,600. Out of $5,800. That leaves $200. For savings, for repairs, for birthdays, for emergencies. Then one month, Daniel misses work for 3 weeks. A minor surgery, unpaid leave. Income drops by $1,400. There's no cushion. So they use a credit card, then another, then a personal loan. Now they're not just managing bills, they're managing stress. Here's the key point. They didn't overspend. They didn't gamble. They followed the rules. They trusted the approval. But the system gave them efficiency, not resilience. And efficiency breaks quickly. Resilience lasts. That difference changes lives.
At this point, it's tempting to look at stories like Daniel and Rachel and think, they should have been more careful. They should have saved more. They should have planned better. That reaction is natural, but it's also incomplete, because many people in debt traps are not careless. They're thoughtful, educated, hardworking. So why do they stay stuck? Part of the answer lives in human psychology. One powerful force is validation bias. When your bank approves you, your brain treats it as confirmation. Experts reviewed me. I must be safe. Contradictory signals, tight budgets, rising stress, shrinking savings get pushed aside. Another is the approval illusion. We confuse permission with protection. If they allowed it, it must be reasonable. But as we've seen, permission is based on models, not on lived reality. Then there's status pressure. We are social creatures. We notice what our peers have, where they live, what they drive, and quietly we calibrate ourselves against it. Falling behind feels like failure, so we stretch. Next comes sunk cost fear. Once you've invested years into a house, a degree, a lifestyle, walking away feels unbearable. I've already put so much into this. So you endure. You optimize pain instead of removing it. When reviewing behavioral finance research, one pattern keeps appearing. People don't make financial decisions in spreadsheets. They make them in emotional environments. Fear, hope, comparison, pride, exhaustion. Here's a reflective observation. Most financial traps don't start with greed. They start with normal desires, security, stability, belonging. The system doesn't create those feelings. It uses them. That's why escaping debt is rarely just about math. It's about unlearning quiet psychological rules you never consciously agreed to. And that might be the hardest work of all.
Up to now, we've talked about structures, incentives, and pressures. But this story is not about helplessness. It's about positioning. Because while you can't redesign the financial system, you can redesign how exposed you are to it. Think of your finances like a car. You can't control the weather, you can't control traffic, but you can install shock absorbers, buffers that soften the impact when something goes wrong. The first buffer is cash, not as an investment, as oxygen. A simple rule many planners suggest is 3 to 6 months of essential expenses. Not ideal expenses, survival expenses. Housing, food, utilities, insurance, transportation. That number is your breathing room. The second buffer is margin. Margin means living below what you're allowed to. Just because you're approved for a $2,500 payment doesn't mean you should accept it. A safer personal rule is closer to 25 to 30% of take-home pay for fixed housing costs, not because you're pessimistic, because you're realistic. The third buffer is flexibility. Ask before any major debt, if my income dropped 20% for 6 months, would I still sleep at night? If the answer is no, the debt is fragile. Then there's a simple decision checklist. Before signing anything long-term, can I still save at least 10%? Can I absorb one major surprise? Do I have exit options? Am I choosing this for stability or for image? When reviewing household finance studies, one theme repeats. Families with buffers don't avoid hardship. They recover faster. Here's a personal style insight. Peace with money doesn't come from maximizing lifestyle. It comes from minimizing panic, from knowing that one bad month won't define you. That confidence is quiet, but it's powerful, and it's learnable. If you take a step back, a pattern begins to emerge. The system is built on movement, on borrowing, on expansion, on future promises. And most of us are taught, subtly, constantly, that keeping up with that movement means success. Bigger home, better car, higher title, more progress. So money becomes more than a tool. It becomes a scoreboard, a way to measure worth, a way to measure adulthood, a way to measure whether we're winning. But here's the quiet truth. The most financially stable people often don't look impressive. They look calm. They're not chasing upgrades.
They're not constantly anxious about payments. They're not afraid of small setbacks. They have room. Room in their budget, room in their schedule, room in their mind. When reviewing long-term wealth and well-being studies, one conclusion appears again and again. Financial peace correlates more with control than with income. Here's a reflective thought. Many of us grew up believing that more would feel like safety. More money, more things, more status. But safety often feels like less fear, less pressure, less dependency. It feels like choice. A personal insight. The healthiest shift I've seen in people's financial lives is when they stop asking, "How much can I afford?" and start asking, "How much keeps me free?" Free to change jobs, free to rest, free to say no, free to help family, free to take risks that matter. That's not anti-ambition, that's strategic ambition, using money to buy options, not obligations. So if there's one mindset to carry forward from this video, it's this. Money is not proof of success. It is infrastructure for your life. Build it quietly. Build it patiently. Build it so it supports you, not controls you. Before we end, one personal thought. Everything you heard today, I didn't learn it from one book, or one course, or one expert. I learned it slowly, through mistakes, through stress, through asking better questions. Understanding money didn't make me perfect, it made me calmer. And if this video helped you see things a little more clearly, then it did what it was meant to do. If you're building a healthier relationship with money, you're welcome here. So take care of yourself. Take care of your future. And if you'd like to keep learning together, you can subscribe to RU Talks Money. No hype, no pressure, just clarity. I'll see you in the next one.